once. So what we now do is that you prepare, because the error that you want to correct is the error that occur in the cash account, not savings account. I told you it affects only one side of the account. So cash account, then you prepare suspense account. Now you now return the money back, which is the suspense. So then cash, this is a 300. That means you return this error because it is not supposed to be posted twice. You return it back and you prepare your suspense account where the error occur at the end of the day. So that is that on the two entries on the same side. So the last but not the least, we have trial balance error. This error occur when trial balance is not totaled correctly. This is the aspect of figures, not have to do with the item. At the point you are calculating the figure, let's take this the trial balance. This is debit, this is the credit, this is 500, 500, this is 500, this is 500, this is 1,000, and this is 500. So you now write 1,005, then you wrote 1,000 at the end of the day. You see that it is a trial balance error. It is a cause when the figures are not totaled correctly. This one will be 500, so the difference here is 500. So this is what we call trial balance error. So I cited those examples so that you could be able to identify this error when you are given in the exam. You're able to identify that this is the error of omission, this is the error of double entry, this is the error of original, this is compensating errors, and odd life. Because even in the real sense, in practice, it does normally happen when you are calculating figures and when you are posting some items, and in the course of treating it, you could error might want to set in at the end of the day. And when such error set in, then you identify it. That is why this kind of topic is introduced, so that we will be able to identify our errors at the end of the day. Topic 3, trading account. We've talked about classifications of accounts in the theme 4. We're talking about trial balance and the correction of errors. Now we'll be talking about trading account. Why are we preparing trading accounts? We are preparing trading accounts. You know, we have different type of company. There are companies that they trade, and when we're talking about trade is that you buy goods from the market and sell it to, is when you buy goods and resell it again. So you prepare account for it at the end of the day. But manufacturing account is a kind of account whereby it is a company that is manufacturing goods. We call it industry. So they prepare their own account. So a trading account is the account constructed for the purpose of finding gross profit or loss of a business at a particular period. It is a revenue account and form part of the double entry system. I told you double entry principles is not something that you can underestimate, because it is the fundamental of accounting. So every ledger, every account are attached with double entry principles, of which if violated might cause a problem when you are preparing your account. Now, what are the terminologies of trading account? What are the items that are likely to emerge when you are preparing a trading account? Number one, we have sales. Sales represent the total cash and credit sales during the year. You know that when you make a transaction, you can make it on a cash basis or credit basis. So when you make a sales, you can make sales on a cash basis or credit basis. But that doesn't prevent you from calculating the total sales. at the end of the day. So the total sales, both the credit and cash, must be total together to get your total sales during the period. Then we have a return inward. What is return inward? This is the total value of goods returned to the seller by the customer out of the goods previously sold to them. And it might occur when the goods that is being bought are spoiled or some of them are not good. So you return them back to the seller that sells those goods to you. So that's what we call. So, and you as a seller, maybe you sell goods worth of 1,000 naira, and your customer return 10 out of it, 100 naira out of it. That means your total sales will not be 20 again, 1,000 again. Your total will be, the total sales you have will be 900. So because return inward has reduced part of your sales. We will see when we get to the illustration how we treat them in the trading profit and loss account. Then we have turnover. Well, turnover is the total net sales during the period of time. This means sales less return inward. This is what we call, this is your sales, this is your return inward. So this is what we call turnover. And the turnover is also the same thing as sales. They can use, you know, we have accounting terms. We have, every professional has his own terms that they use to, it is known among the people that are within the same profession. So turnover is also the same thing as sales. So to get your net turnover, turnover is a sales less return inward. Then return outward. This is the total value of goods returned to the supplier out of the goods bought. You as the company, you bought goods from the supplier. So the goods are spoiled. So you purchase 1,000 goods. Then you discover that those goods are not good. Then you return it back to the seller, which is that means you are not buying 1,000 goods again. You are buying you are purchasing 900 worth of goods. That is how you treat a return inward in the trading account. Then purchases. Purchases, this represents the total of cash and credit sales for the sale. You could see that those items is the way the techniques I gave you the other time when we are preparing Trabala. That is also the rules that you follow when you are preparing trading profit and loss, because it is also part of the double entry principle. So it represents the total cash sales you purchase and the credit sales at the end during the period. So that is the sales. Then we have carriage inward. Carriage inward is the cost of transportation charge on goods purchased. You know, as a buyer, when you go to the market to buy some goods, the transport or the car that will convey that goods to your destination, you have to pay for it. So that's what we call it carriage inward. So that is that. Then we have the carriage outward. This is the cost of transport charge on goods sold to customers. You are selling some goods to your customer, and the transport that take it to the destination of your customer, the cost that you incur at the end of the day is what we call carry outward. Then cost of goods sold. This is the total cost of goods actually sold by the organization. Cost of goods sold. So that is that. Then we have we illustrate that when we get to the question per se. Then cost of goods available for purchase. This is the additional of opening stock and purchases. Then we have opening stock. What is opening stock? This represents goods available in a business at the beginning of the period. Let me lay more emphasis on the opening stock. You know, at the end of the day, it is most actually not possible. It is not actually possible for you not to dispose all your stocks during the year. As at the time that you are preparing your account at the end of the year, you discover that you have some leftover stocks that have not been sold at the end of the day. So when you are preparing another new account the following year, they become opening stocks of your in the trading account. So and you add purchases to it, which will give you many other things. Then we have the closing stocks. Closing stock is the left stocks that have not been sold at the end of the year. But you know, closing stock can form opening stock in the following year. So closing stock is stock unsold at the end of the trading period. Now we go to format of trading account. These we have opening stock, we have purchases. So these are the typical example of the format of trading, and by going by this, it will help you to get your gross profit or loss at the end of the year. So we will cite some illustrations that combine trading profit and loss account and balance sheet as at that date. You just need some explanation on those so that you can adapt equation that combines both the trading profit and loss and balance sheet as at that date together. In topic 4, we'll be talking on profit and loss account. Profit and loss account is the account constructed by the organization to show the net profit or loss. You know, at the point in time when you are preparing trading profit and loss account, you have a gross profit. Gross profit is not your actual profit. Yes, the reason why is that in the course of the business, you have incurred some expenses. So it is when you deduct